Mr. Sandman, bring me a dream. Bum, 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 bum. Make him the cutest.
David Reyes here, back with you. AM 760 KFMB, your retirement architect. Talking about planning, talking about retirement, and talking about protecting what you have first. Warren Buffett's one of my favorite quotes by Warren Buffett is, there's only one or two rules to investing. Rule number one, don't lose money. Rule number two, don't forget rule number one, right? And I hate losing money. It's like nails on the chalkboard to me. Hey, you're going to invest money. You're going to have some ups and downs, but we just want to have those downs be not as drastic. And what I really care most about for you is really as a fiduciary, and for those of you who listen to me for a long time, I'm a fiduciary. I've been for a long time. And what a fiduciary is, basically, we are a firm that has to put your interests ahead of our own. We choose to be that way, and we have to disclose any conflicts of interest, which we do not have. Unlike a bank or brokerage firm, they work for the firm, not for you. And the major advantage that we have with clients, I can just look you in the eye. I can say, look, here's what you got. And tell you what you have and give you the most objective advice possible. In fact, how serious about this is we don't take on very many clients. I mean, we take a couple a month. That's it. And I was sitting with a client last week, and she took me up. She's a very avid radio listener, full of knowledge, right? Knows a lot of stuff, right? But's been burned quite a bit, and she has a little bit of bad taste in her mouth. And but she sat down with me. She said, David, you've become highly recommended from some people that I respect. And, I want to get your opinion. You offered me a second opinion and a copy of your book, which I gave her and her mom. And we sat down and spent a long time with her. And I said, you know what? I just can't help you. I think what you're doing is okay. There's some things I could probably improve upon, but it just doesn't, there's just not a fit. And we spent probably a couple hours, 2.5 hours together total between two meetings that I did for her. Because I sat down with her, which I do with every client, and we got to know each other. I said, well, let me analyze what you have. And because she was really sweet, and she really wanted some real good advice, solid advice. So I sat down with her a couple weeks later after I'd reviewed her portfolio. I said, look, and it was for her mother. And I said, your mom's portfolio, she was in her 80s, right? And sweet lady. And I said, look, here's the issue. I probably could help, but I don't think incrementally I could help enough to take you on. And so really, I think you should stay with what you're doing. Here's a couple questions for your advisor. And I'll get back to you on those after you ask him. I'll give you my opinion. But I told her I can't help you. And in a very positive way. I helped her understand first what she had, and that made her feel very comfortable. And I said, you have some risk here, but they're fine. And there's just not a high. We have three criteria for our firm with clients. Is A, we have to like each other, right? You have to like me, I got to like you. That's just, you can't do business without having that. And I use that term loosely, but that's for lack of a better word. There has to be some chemistry, synergy, whatever you want to call it. Number two, we have to make sure that we can offer as a firm, my firm, our firm, that we can offer high value to you. If we can't, then we won't take you on as a client, because that's just, it's not worth the time and energy it's going to take for you to switch advisors, to switch your investments, to do things high value. And number three, philosophically, we have to agree. And this is over 2 decades of doing planning for clients. I just came up with these things one day and wrote them down. I said, that's who we are. So with this particular client she was a sweet gal, wanted to help her. Philosophically, we agreed. Rarely, and the middle was the one that got us, was that I couldn't offer high value to her. Philosophically, we agreed. Great person. But I said, stay with what you got. She appreciated that so much. It was awesome. So if you want to get a second opinion from me, an objective opinion, really, as a fiduciary, looking out for your interests, legally, give me a call, 1-800-611-1967, 1-800-611-1967. And again, ask for the complimentary second opinion. We also provide a stress test on your portfolio to make sure you're not over-allocated to too risky investments. The average I see is about 30 to 40% losses if we experience another '08. That's unacceptable. If you're entering your retirement, there's no way you can take on that kind of risk. I mean, I say that generically. 99% of you can't take on that kind of loss in your portfolio. Not only that, you don't want to. Okay? So again, if you want me to do a complimentary second opinion, we have CPAs, we have attorneys, we have people. We do. This is on everything. This is on your taxes, your investments, estate plan, retirement plan or lack thereof. So this is not some cursory. I used to charge $2,500 to do this. This is a serious review. So if you want to take me up on it, again, give me a call, 1-800-611-1967. That's 1-800-611-1967. Or reach me on the web at reyesplan.com. That's REYESPLAN.com, reyesplan.com. And also go there to sign up for our next workshop. It's going to be regarding Social Security, retirement planning, the market, taxes, all kinds of fun stuff. Again, go to our website, reyesplan.com. So what else here? I've got a couple things here I was looking at this morning. One of the things that I'm concerned a little bit about for clients, and I want to make sure that you, all I care about when I sit across the table from you is, number one, do we have, well, it's really simple. Do we have enough income to last you and your spouse enough for the rest of your life? That's it. And with taxes, inflation, healthcare costs, all these issues that are targets to your retirement. And there used to be a term called the 4% rule, and that was how much money you could take out of your portfolio conservatively without running out of money. Okay, and it was kind of like the benchmark, and that happened in the 90s. And in the 90s, we had two things. One thing we don't have right now. One thing we do have right now. During the 90s, we had a very strong stock market. We have that right now. One thing we had in the 90s was higher interest rates. Interest rates were around 6%. What do we have right now? 10-year bond is at 2%. Okay. 30-year bonds below 3%. You had 6% normalized interest rates during that time. So, yeah, of course you could take out 4% during the 90s on a forward basis. But the problem is now Morningstar has said that you can only take out 2.8%. So one of the strategies we use that's really simplistic is because bonds are really a very high-risk asset right now. If we have, for every 1% increase we have in bond interest rates, you will lose about, on a 10-year bond, about 8%. We're now at 2%. So if we go back to 6% on the long-term bond, you're talking about the 10-year bond, you're talking about up to about a 30% loss in your principal. That's ridiculous because there's more pressure on rates going up than they are down. So Warren Buffett says it great. He says, bonds should come with a warning label, okay, because they're basically a return-free investment with very high risk. And so what do we do with that bond portfolio? Real simple strategy I use. So bonds are high risk to me right now. We're not getting paid a lot of money from them. Let's replace the bonds. I show this in my workshop with a really good inflation-protected annuity. Okay, that's going to pay us not only now we can get 5 or 6% distribution rates, not 2, and we don't have the interest rate risk. The annuity company is going to pay that over our lifetime, plus we get cost of living adjustments. And I'll talk about the silent killer and maybe in a little bit if we have time, which is inflation. So we want to make sure not only do we not lose that, so we want to make sure we can grow that portfolio over time. So one of the simple ways is take a portfolio, replace the bonds with annuities, about double or triple your income right from there without having the risk of principal, which you have within bonds. So if you'd like to hear more about how I do this from a fiduciary standpoint, from an independent standpoint, give me a call for a second opinion, and we'll talk about how to increase your retirement income distributions without increasing the risk. That's 1-800-611-1967, 1-800-611-1967, or again, reyesplan.com. That's REYESPLAN.com. And again, today I'm giving away 5 books for every 5 free books for the first 5 callers that call. We've already had a few, so I think we only have 1 left. I think we're up to 4. So 1 left. So the next caller, it will get a complimentary second opinion with me, David Reyes, and also a copy of my book, Successonomics, written with Stephen Forbes, Amazon bestseller. Great book, written with other advisors as well that are maybe, smarter than I am. I know Stephen Forbes is. So take me up on that again, 1-800-611-1967, 1-800-611-1967 for your complimentary second opinion risk assessment. How much time do we got left here? We got 2 minutes. Oh, good. We got 2. Oh, awesome. We got 2 minutes. And I'm going to talk a little bit about one of the things that we do for a lot of our clients that's highly unique is we do a lot of, I would call multi-generational planning, meaning that for your kids, let's call it what it is. So we will help you plan not only for yourself, but what happens to your assets when you're not here anymore, right? And hopefully we do a good plan where, number one, I care about you first. I got to make sure you have the most successful retirement you can have, that we've taken care of all the issues, long-term care issues, taxes, inflation, all those things that are threatening our retirement, maximizing Social Security. And then we want to make sure that we have money, if it's left, to give to our kids in the most economical way possible, the most tax efficient way possible, to give them the most amount of money. So I'm going to talk about that. We're going to talk about a strategy I use all the time for the majority of my clients, and these are special trusts that we use for IRA assets. And most of you don't know, but when you pass, even if you don't have an estate tax issue, you have basically an estate tax on your IRA. And I call it that. It's not really an estate tax, but it's a tax. It's an income tax. And it costs you 40, 50% of the value of your IRA when you pass. So let's say you had $1 million IRA, and when you pass away, it's $500,000, or it's still $1 million. We did a great job for you. How would you like your kids to lose 50% of that IRA to taxes? How would you like them to lose that IRA because they got divorced? How would you like them to lose that IRA because they killed somebody in a car accident? How would you like them to lose that IRA if they got sued? What if I could show you a strategy to where I could protect you from all of those things? Taxes, liabilities such as lawsuits, litigation, bankruptcy, divorce. And, I know I've got 3 kids. I've got 2 daughters. And the last thing I want to do is, have their inheritance go to the spouse that they're not married to anymore, go to somebody that was not deserving of that. So we're heading to our last segment, and it's been so much fun so far. We've had lots of callers on our second opinion, and you'll get that book at your meeting, signed by me, David Reyes, your retirement architect, here on AM 760 KFMB.